If you think oil and gas companies are going to go bankrupt in the next few years, listen to this energy analyst explain the consensus view of oil and gas company profits.
So we know from day to day, oil can jump, it can fall sharply. Where do you see it long term?
Yeah, I really think it's important for viewers to understand that the geopolitics is never a good thing. It's a distraction, and it keeps people from seeing what really matters. What matters today is inventories have been falling at the fastest pace in history. And it's occurring because demand is now back to pre-COVID levels, and it's going to surge later this year as we're all able to travel and the inconveniences of testing and quarantines and such get lifted. And yet there are structural challenges to supply growth. The era of U.S. shale hypergrowth is over. This disruptive force of the past 10 years is no more. We expect shale to grow by 800,000 barrels per day approximately this year. So still growing, but not in excess of global oil demand. And so there is now a call on OPEC. There's a call on the super majors, but it's a call that they can no longer answer because OPEC is set to exhaust its spare capacity in the coming quarters. And the global super majors under enormous pressure to decarbonize and invest in renewables, wind, solar, et cetera, have been insufficiently investing now for 7 years. And so we see an environment where inventories continue to fall this year, putting upwards pricing pressure. And ultimately, this is a multi-year bull market oil that I think will last at least 5 to 6 years and will end in all-time high oil prices.
Okay, let's talk about that all-time high oil prices. I think RBC came out the other day with a call of flirting with $115 this summer. Where do you think we're headed?
Yeah, they sure did. And so we've been bullish, and I really respect Mike Tran's opinion. We've been writing about this for a year, and we're no longer alone. A lot of consultants that we use, like Energy Aspects, is calling for oil of over $100, not just like a flash in the pan, but importantly, a sustainable price in excess of $100 per barrel. And so calling it to a dollar, dollar by dollar basis, it is 99 or 101. It really doesn't make a difference. When you look at energy stock valuations today, even at $80 oil, so take $10 off the current oil price, the average Canadian energy company can privatize and become debt-free with 5 years of free cash flow, and yet they're sitting on 15 years of inventory. If you want to believe in 100, which isn't that far away, that number shrinks to just over 3 years with an average free cash flow yield of 38%. And so we're in an environment where companies no longer want to grow. They've already delevered. And so it's a golden age of free cash flow that is going to result in very material dividends and dividend growth for all companies. Every energy company is going to, I think, become a very significant dividend payer. And that will help lead to a re-rating in valuations. Because at $80, again, stocks are trading at a half to 1/3 of their historical multiple. And so I think meaningful action on the part of returning capital will help fix that. Last year was about return to the debt holders. This year is about return to the equity holders.
Even as well as the energy index has done, even to start this year, far and away the leader to the percentage upside, do you think that we're still undervaluing these names considering the current environment?
So much of the returns of last year, like we were up 186%, we're up 30-odd% this year. A lot of that was repairing the damage that occurred in parts of 2020 when stocks fell by 60, 70, 80%. For those who've enjoyed those returns, you're burdened with that and you think, is there something bad that's going to happen to take away the gains? For most people that haven't had exposure to the energy sector, the average guy is still underexposed to this sector, which is still mind-blowing to me. With a fresh set of eyes, take $10 off the oil price, the average stock can pay a 26% dividend from free cash flow while keep production flat at an oil price $10 lower than where we are today. And I think we're going meaningfully higher in the years ahead. So I still think energy stocks represent a generational opportunity. Yes, they'll be volatile. I think there will be an Iranian deal coming the next week or two. Maybe we take a few dollars off the oil price. But here we have today, oil is down 4%, and my fund is up at the moment. And so energy stocks are looking through that. There's an appreciation that we're in a structural bull market that doesn't rely on Ukrainian war. It doesn't count on a non-deal with Iran. The market is structurally undersupplied. Demand is surging, and I'm challenged to see where the necessary barrels are going to come from in the years ahead.
All right, with that as our backdrop, you have some names for us to go through. Let's start with Meg Energy.
Yeah, Meg is incredibly mispriced. Here you have a 60-year asset, completely unhedged this year. It's trading at just over 3.3 times next year's cash flow at 90. It's trading at a 33% free cash flow yield. So if they can buy back all of their shares outstanding and become debt-free with just over 3 years of reserves, and so you're effectively getting 57 years of free cash flow for free. And so we think they're going to achieve deleveraging very, very soon in the coming months. They've announced they'll be flowing back 25% of free cash in the form of buybacks. I think that's imminent. And by the end of this year, we'll be looking at 50% of the free cash flow. So this is a company that they could buy back 15, 20% of their stock a year to allow for a re-rating in their share price. So this is a very, very mispriced stock. We get about 150% upside at $90 oil. And if you want to use 100, we're getting more than 200% upside in the name.
All right, so that's Meg Energy. You also have Enerplus on your list.
Yeah, Enerplus trades like a broken company. It trades at just over 2 times annual cash flow. They think they have at least 10 years of stay flat inventory, and they're aggressively buying back stock. They're even divesting assets in, old tired assets in Canada, potentially their Marcellus. If they do so, I would expect a meaningful buyback as well. We have it trading at a 33% free cash flow yield. So this company could privatize and become debt free with 3 years. So you're effectively getting 7 years of a theoretical 33% dividend yield for absolutely nothing. That is where the best opportunity for investors is today, buying long dated reserves for which the market is giving like a fraction of the value to.
ARC Resources, tell me what's going on with this one.
Yeah, ARC's a gas name, but it's also a massive condensate producer. So think of it as it's essentially a liquids producer. It's trading at 2.8 times cash flow at $90 oil. They think they have at least 2 decades, so 20 years of flat production using the same quality of acreage, and yet they're trading at a 25% free cash flow yield. So they can privatize in 4, you're getting 16-year annuity of theoretical 25% returns per year for absolutely nothing. So the challenge with energy investing today is everything looks good. Gas looks good, services look good, oil looks really good. The goal is really to find the stocks that can massively outperform while taking on less risk. And the market today is so inefficient that garbage is trading at the same value as quality. So for an active money manager, you can find opportunities where literally you can get 10, 15, 20 years of free cash flow for free, because people all think we're going to be driving electric cars in the next 2 years, and peak demand is going to be a year or 2 out and the oil price is going to plummet. You can take advantage of energy ignorance by getting something for nothing, and that something is hugely valuable, and I think whose value is going to increase in time.
Eric, I'm almost out of time with you, but I did want to ask you, I know you're using this for illustrated purposes in terms of the free cash flow, the gushing of cash that they could, go private, pay off all their debts. Would you anticipate any company in this space going down that road in the coming years?
I don't, because the action of doing so will lead to a re-rating in the share price. My math uses a static share price, and of course I would expect the share price to go up meaningfully. So I don't think I'm going to be out of a job in 3 years when the entire sector privatizes. What I'm imploring management teams to do, and I think they're listening, is to use free cash, moderate growth, maximize free cash flow, and take advantage of the generational opportunity in stocks trading at half to a third of their historical multiples and being the buyers of their stock. Meaningful action by doing that can lead to a very meaningful re-rating. And so, yes, we can benefit from a rising oil price, but the low-hanging fruit is a re-rating in the trading multiples, given how depressed they're still at, despite very strong gains this year and last year.
Always great to get your insights, Eric. Thanks for joining us today.
Thanks so much for having me.
Eric Nuttall, partner and senior portfolio manager at 9 Point Partners.